I am grateful that we will get to dialogue here and see why it is that that warmth and friendliness of the organization does not seem to shine through we the people who come after the taxpayers. And I am glad that you have rightfully mentioned the rights and the obligations of a taxpayer. We know that everywhere where there is a responsibility, there is an equivocal right accompanying that taxpayer. And we're looking forward to having a dialogue with you. So let's move forward and hear from our next presenter, Mr. Arnold Langat, who is a compliance officer with over 5 years experience in tax administration for the Kenya Revenue Authority. Arnold joined KRA in 2015 as a graduate trainee and has extensive knowledge and training of tax laws administered by the KRA. He is passionate about governance, public policy formulation and administration, risk management, and taxation as a driver of development. Arnold has a BSc in Actuarial Science from the University of Nairobi and is a certified public accountant. He is also a continuing master's student focusing on studying public policy and administration. Welcome, Arnold. We're looking forward to hearing from you. He will be breaking down the relevant tax laws that we need to be aware of and the different mechanisms around compliance. Thank you, Arnold. Karibu.
Asante sana, Kezi. Thanks for the introduction. And it's a pleasure to be here on this webinar that you've invited KRA to come and partake in, to take through the participants on the tax laws that are applicable in this kind of industry. I also want to thank Samantha's Bridal, led by Dr. Masita, for organizing this series of wedding industry summits. Even though this year and the last year we've had the pandemic and it has changed the way things are done, probably if things were normal, we would have this in a hall somewhere and all done within a day or two. But now we have to adapt to the new way of doing things and do these things online. I couldn't help but notice that I'm also the only gentleman in the panel. This is interesting. And I'm in a panel full of women of grit. You are really achievers in your industry. And the wedding industry has been growing over the past few years. It has seen many participants getting into it and actually doing it in a better way than we've always imagined. So I've put up together a presentation. I will share a PowerPoint on your screens. And basically we'll just be covering the tax laws that are covered by KRA, that are administered by KRA. So I see that I can't share the screen. Maybe the host can enable me to share the same so that we can be able to digest the tax laws one by one.
So, Stanley, we are trying to make you host. Just a few minutes.
That's okay.
Just bear with us.
That's okay.
Sorry about that. Yeah.
Okay.
I want to just jump in as we're giving Catherine a moment to resolve back-end issues. And maybe, Arnold, I know that you're yet to give your presentation, but let me just throw in a question, even to yourself and to JD, just to get us thinking and brainstorming as we are getting the back-end sorted. So one of the biggest concerns, one of the biggest, and I see your host now, perhaps I should allow you to first go ahead so that I don't jump the gun.
No, that's fine. So, it's okay. Maybe I can just do the presentation.
Perfect.
So that later on we have questions and queries. We can do a deliberation and a discussion.
Great.
All right. So sorry for that small inconvenience. We can quickly go through the presentation I put together for you. And it's not gonna take long. I hope you can access it now. This is a slide, about 35 slides, which is technically covering the taxation, the tax heads that are administered by KRA. So without much ado, let's dive right into it. And you can see on the screen that there are tax categories that would any player in the industry of wedding industry might encounter. Some of them you have to pay or at least participate in, you have obligations in them. Some of them, depending on the conditions you need to meet, you may not pay, or you could pay depending on the threshold that you meet. So without much ado, let's dive into income tax. Income tax is really one of the major tax heads, or one of the oldest tax laws that were enacted in Kenya. If I recall correctly, this one began in 1974 in Kenya. And we were still using laws that were left to us by the Britons, which we've been improving ever since. And income tax will encompass many things along the way. We have pay as you earn, which is technically taxation on the salaries or any kind of pay that you pay to someone that you would consider an employee or someone who has rendered services to a principal. That is someone acting as an agent to someone. Then we have turnover tax, which is technically payment of taxes based on your turnover. And we shall look at why someone would pay turnover tax and who qualifies to pay turnover tax. We also have advance tax for owners of commercial vehicles and public service vehicles. We also look at why they need to pay the advance tax and when they do pay the advance tax, penalties in case you don't comply and all that. We also have withholding taxes, which is part and parcel of the income tax. And withholding taxes is subject to certain incomes. Not all of them are subjected to withholding taxes. And we'll be able to know which kinds of incomes are subjected to these withholding taxes and at what kind of rates. Then we have another tax head, which is also administered using the Value Added Tax Act of 2013. That is basically tax on value addition or provision of goods, services, or it used to be called sales tax, which basically, if you look at the term sales tax, it means it's a tax on any kind of sale, which is taxable at the various rates as well. So maybe I can give just a brief look of how Kenya has been acting since not even far ago, 2003, we used to have a national budget of around 250 billion. That's about almost 20 years ago. 200 billion is a small amount of money currently because our current budget stands at around 2.9 trillion, that is. So you've seen that Kenya has been growing tremendously in terms of collection of taxes and levies. And the main contributor to this is that many people are now contributing to the national cake. They give contributions through taxes and any other kind of levies. And KRA has been at the forefront to try to expand the base so that most people, or most people that earn any kind of income, participate in payment of taxes. If you know the tagline of KRA, it usually says tulipe ushuru tujitegemee, which means that the more people actually do pay taxes, the more we get to plug in our budget without having to borrow from the foreign banks or any other foreign financial institutions. So income tax is an act which is in the chapter 470 of the Kenyan laws. As I said, it has been in effect since 1974. And up to now, we're still administering this, of course, with amendments year on. Every year we have a finance bill that seeks to change maybe the laws, introduce some new taxes, but all that is covered under the income tax and many other revenue acts. So income taxation brings to charge various incomes. So incomes in the sense that anyone who is participating in any sort of income making activity, then you would have to check this section of Section 3 if it brings that kind of income that you are earning into charge or into taxation. So we have a definition there that says a tax to be known as income tax shall be charged for each year of income upon all income of a person, whether resident or non-resident, which accrued in or was derived from the boundaries of Kenya. So that definition is a very mouthful one because it tells you that there is a tax which is to be known as income tax. It shall be charged on each year of income. That's why we have every year we file returns for individuals and both for corporates. And we declare the kind of income that we earn during the year, whether we earned it in Kenya or in another foreign country. By residents, there are people who are called residents, and then there are those who are also non-resident in Kenya, but they have earned that income in Kenya. So such kinds of income are brought to charge under this section, Section 3 of the Income Tax Act. The types of income which are chargeable to tax are listed here. We have business income from any trade or profession or vocation. So business income is generally what brings the incomes of the players in this industry of wedding industry. All those incomes that you earn are brought to charge through the definition of what a business is. Then we also have income from employment or from services rendered. This is what we mentioned earlier as pay as you earn, pay. That is for employees to any kind of person who is hiring employees or engaging someone in a capacity of an employee. We also have rent income. That is income from letting out any kind of property, whether movable or immovable. We also have pensions incomes. We have investment income, which is basically dividends and interest that you earn from interest you can earn from a bank or any other institution that gives you interest on your deposits of monies. Dividends is basically the reward you get from having a shareholding somewhere in a certain company or institution. So all that is also called investment income and is subject to tax at a certain specific rate. We also have capital gains, which is a tax on sale of properties or transfer of any capital property, which over time appreciates in value. And then the gain that you get from selling that property is taxed with a tax called as capital gains tax, CGT. So as I mentioned earlier, business is a term that is defined by law to include many things. this definition is very important because we need to bring in as many types of, we don't need the law to close out certain incomes, and at the end of the day, the KRA will not meet the target if we don't have certain incomes being within the purview of the definition of business. So business, as defined by law, is a trade, commerce or manufacture, profession, vocation or occupation, any other activity in the nature of trade, commerce or manufacture, profession, vocation or occupation. Any activity by a person continuously or regularly, whether or not for gain or profit, and which involves in part or whole the supply of goods or services for consideration, or a supply of property by lease, license, or similar arrangement. So that definition, which has about 4 bullet points, can bring any sort of business into the purview of taxation by looking at any kind of what kind of activity you do. If you're in an activity which is in a way similar to trade, then you know that is taxable. If you are a profession, and also profession is defined in the Income Tax Act, if you can refer to the act, actually you will find the many professions listed there, some of them including maybe accountants, lawyers, doctors, and such like. So professions are defined also in the act. A vocation is something that is sort of a calling. If, for example, in the wedding industry, we have someone that is a comedian somewhere, and you have a habit, or the people prefer to call you to their weddings to divert a crowd and maybe make them laugh, or become an MC, then that is your calling, and that kind of income you get at the end of the day is also brought to taxation through this definition of a business. We have an exception here, that is, it does not include employment, because employment is taxed under pay as you earn. A hobby, something that you do as a leisure activity, you don't hope to get any sort of income from it. Then that one is exempted from the definition of what a business is. So right here, we have a picture of pictures of various players in this industry. Not all of them, but we can just try to list that. If you are a photographer, you provide maybe cakes, you provide tents and decor, you provide catering services, you hire out grounds for weddings, you are an MC or you are an officiant in a wedding. We have pastors who are actually paid to officiate weddings and all that. We have MCs who are paid to technically take the wedding through. All those kinds of people are players in this industry, and the kind of incomes they earn are brought to taxation through what we are going to check in the next few slides on where each and everyone falls on. So income for tax purposes arises where business, which we have defined, is carried on wholly in Kenya, partly in or partly outside Kenya, and the gains and profits deemed to have accrued or have been derived in Kenya. So such businesses that you've carried out, whether you did it in Kenya or you did part of it in Kenya, part of it outside Kenya, or even if you're outside Kenya, but these gains are deemed to have accrued or you have derived them from Kenya, then that kind of income is taxable in Kenya. And there are 3 ways in which someone can account for their taxes. Either you are a sole proprietor who is operating your own business, you haven't even registered a business name. Let's give an example of someone who is a photographer. You are starting up your game in the industry. You haven't registered a business name, but you're carrying on business as your own, with your own name. Then you can account for your taxes using your own individual PIN number, which I know most people are registered for a PIN number as soon as they hit 18 years. We also have a partnership where 2 people or more can come together to carry on business for the purposes of making a profit. Such kind of thing is called a partnership, and a partnership may be formed and registered with a PIN number in KRA, but the people to pay the taxes are actually the individual partners, not the partnership registered itself. At the end of the day, the partnership will just tell us we made such profit or loss. We have shared this loss or profit in this kind of ratio, and then now the partners will account for the profits that they have gained from the partnership. We also have a company or a limited company, and the definition of company may be limiting because we also have in the corporation world, we have other entities such as the churches, which may not be a limited company. We may have circles, we may have cooperative societies. All those fall under the term of company in the Income Tax Act. So all those kind of players who are in that section will account for their taxes using the company. And the rate is at 30% at the moment for resident companies and 37.5% for foreign companies, or who we call non-resident companies. For partners and individuals, the taxation is taxed using a certain scale, which ranges from 10% to 30% depending on the level of income. It's called a graduated scale. I'm sure most people who have ever worked in any kind of environment where you get a pay slip at the end of the month, you can be able to see that the taxation is on a graduated scale depending on your income. If I can just give an example, at the moment, if people earnings between 0 to 24,000 shillings, you'll find that you're not paying any taxes to carry because that one is taxed at 10%. So 10% of any amount less than 24,000, the maximum would be 2,400. And the relief at the same time is more than that, the personal relief. So you'll find that someone at that bracket may not pay taxes. But as you advance now with your salary to maybe 30,000, then the next rate will kick in at 20% and so forth and so forth. So how do you account for your taxes when you have earned an income, either as an individual, as a company, or as a partnership? So you have these three ways of accounting for your taxes. One of them is through the payment of installment taxes. This law was effective from the 1990, and installment tax is actually a tax paid. It's like a way of paying taxes in advance as you anticipate to close the year. So what you do is you will determine how much taxes you need to pay in 4 installments, which is paid during the year as you progress. And to determine the value of each amount, you have to look at, if you've been operating, then how much taxes did you pay last year? If, for example, there are more than, you expect to pay more than 40,000 in this current year, then you qualify to pay for installments. And if you split the 40,000 into 4, then that would mean you pay installments of 10,000 each and every quarter. For someone, for example, who has their year running from January to December, that is mostly for individuals, you will pay your installments on the 4th month, the 6th month, the 9th month, and then finally the 12th month. So that is for someone who has a January to December period. You pay that in April, June, September, and December. But then for corporate companies, they have the liberty to choose the way their year runs. They can choose an year that runs from March to the next February and so forth. So they will just use that same formula to determine when they pay their installments on the 4th, the 6th, the 9th, and then the 12th month for their installments. Then we have something called minimum tax, which has been introduced or is effective from this current year, 2021. And this will go hand in hand with the installments. This minimum tax has been introduced mostly to make sure, as I mentioned earlier, the tax base needs to be expanded. We need more people participating in payment of taxes. There are industries where people might make losses for a long time, which means that the fact that taxation is based on a profit, it means that KRA will not get any dime from them for as long as they are making the losses. So minimum tax has been brought to make everyone, or make this taxation inclusive for everyone. So if you are someone who has been paying installments, you determine your minimum tax as well based on the sales that you've made in that quarter. So for example, let's just use a simple basic example of January to March. That's 1 quarter of 2021. How much sales do you have at that time? And then you tax it at 1%. If that amount that is 1% of that sale is more than the installment tax you are supposed to pay, then you pay the minimum tax. If the installment tax that you're supposed to pay is more than the minimum tax, then you pay the installment tax. So that's why they go hand in hand together. And for minimum tax, the people who have been on losses, technically, because when you're on a loss, you won't be paying any installment taxes on the account that last year you did not make any payment of taxes. Therefore, this year you will not even make any other payment for installment taxes. So technically, as someone who is making losses, you will be paying KRA minimum taxes every quarter based on the sales that you make. And then we also have the next way of accounting for your taxes, which is payment through the balance of tax. Balance of tax, or the final tax, is now for someone who has been paying installments during the year, and they finally know the results of the year. You know how much profit you've made, how much taxes you're supposed to pay. So the balance of tax is basically the difference between what you are supposed to pay for the year minus the installments that you have already paid. That's why it's called a balance of tax. Then we have the third way of accounting for your taxes is through the tax returns, which is basically filing of your returns. Income tax is filed once per year using the income tax company return, which is IT2C in short. We also have ITP, which is income tax for partnerships. Then we have IT1, which is income tax return for individuals. So once you do all the three ways of accounting for your taxes, you are deemed to be compliant, and you have to do them within the due dates provided for by the law, which is basically 6 months after the year end, you're supposed to submit your tax return. Installments are paid in the quarters that I've mentioned. Balance of tax is paid by the end of the fourth month after the accounting period ends. So if your year ends in December, your balance of tax should have been paid by April the 30th. So that one is for your observance. The next tax head is actually pay as you earn, which is still under the income tax. And section 3, subarticle 2A, provides that a tax is chargeable in respect of gains or profits from employment or services rendered. So this is technically the section that charges your salaries, your wages, your sick pay, your per diems, and everything. This is the section that brings to charge all those incomes that you earn as a result of being engaged as an employee in any particular entity, organization. And then further to that, section 5 provides that an amount to be paid by a person who is or was at the time of employment or when the services were rendered was a resident person in respect of any employment or services rendered by him in Kenya or outside Kenya. So technically this section defines who a resident person is and who a non-resident person is. So both people, the resident person and non-resident person, for any kind of services that they offer in Kenya, their incomes are chargeable in Kenya. And you might ask, what do you mean by a resident person and a non-resident person? And we would have a definition here that says a resident person is someone who has been in Kenya has a permanent residence in Kenya. Maybe they were born in Kenya and they've been lived in Kenya most of their life. And such a person, as long as you have a home in Kenya, what we call a permanent establishment, then you are a resident by default. So your incomes both here locally and foreign income is chargeable here in Kenya. A person who also has no permanent home in Kenya, but was present in Kenya for an aggregate of 183 days or more in a year of income, that person is also a resident. Then someone who does not have a permanent home present in Kenya for an average of 122 days in the current year of income and 2 preceding years of income. So if we are looking at the current year of income of 2021, this person has had to be present for an average of 122 days in the current year and the preceding 2 years, 2020 and 2019. That's the definition of a resident person. A non-resident person is technically someone who does not have a permanent home in Kenya and does not meet these conditions here. So the tax on pay is actually accounted for by employers only. That's why we have employers, we have taxed them with the function of filing their returns monthly by 9th to ensure that they have deducted from their employees and remitted to KRA. And the tax rates for individuals is graduated from 10% to 30%. We've mentioned some examples of such incomes: wages, salaries, leave pays, per diems, bonuses, and all that. And there's a definition there that says applicable to employment income of above 12 to 60. That one is also variable depending on the kind of year that we are operating in. You've realized that since last year, the amount has been shifted higher up because of to relieve those who are low income earners. So when you look, you have to look out as well for the Finance Act to determine the threshold which is operational at any current year. And as part of employment income, then there's some of the examples of taxable incomes, and then there are those that are not chargeable. So for example, fringe benefit tax. Fringe benefit tax, if you are an employer, if you are someone, you are an event planner, let's say, you have engaged some employees and you have a big company that may advance loans to the employees at very friendly rates, then you are liable to pay what we call a fringe benefit tax. And fringe benefit tax is usually taxed at corporation rate on the difference between the market interest rate, which is published by KRA regularly, minus the kind of interest that you've given your employees. For example, if you give your employees a loan at 4% and the market rate is 8% as published by the KRA commissioner, then the difference of 4% of the interest is what you pay taxes on at corporation rates to KRA. Then we have non-cash benefits above 3,000 shillings. If you give anyone maybe airtime that is worth more than 3,000 in a month, that one ought to be taxed to their salary. We also have a car benefit, which is taxed if you provide your employees or your directors with a car that they are free to use any way they please. They can go on a weekend with it. They can run personal errands with this benefit. So then that is brought to tax by adding the car benefit to their salary. And there are very different ways of determining a car benefit, which is based on actually the rating of the car and or the value of the car, whichever is higher. Then we have value of premises provided by employer. That is in case also you provide houses for your employees to stay in, for the directors, and the company foots the bill of rent, then that one is considered a benefit. And there's also rates of determining how much the benefit is. For this nitty-gritties, I would encourage you to search online for something that is called Pay Guide. Pay Guide is published by KRA, and it has the details on the rates and how to determine the benefit that is provided to any employee. We also have incomes which are not chargeable to tax, they're exempted. For example, if you provide meals to your employees and they do not exceed 48,000 shillings in a year per employee, then that one is not taxable. You have a subsistence or night out of 2,000 shillings. Maybe they are on an assignment and you give them, let's say, pocket money for a day. So it does not have to exceed 2,000. Then medical cover by employer. If you provide a medical cover to your employees as well, that one is not taxable on the employee or the employer, because one of the reasons people are taxed is so that the government can provide some sort of medical cover to Kenyans, or provide better hospitals, better medical care. So if an employer is already doing this for the employees, then it is a benefit to the government at the end of the day. Then we have pension contribution made by employer. Any sort of contribution you make to a pension scheme, it has to be a registered pension scheme, and that amount is usually not taxed. That's why if you are to look at anyone, your payslip, if you have ever been in employment, you would realize that your taxable pay is less the pension that you've contributed or your employer has contributed to a pension scheme. Then we also have bonuses, overtime, retirement benefits, all these which are paid to employees who are low income earners. Then those ones are exempt. So that's all about the taxes on employment income. So if you are a player in the wedding industry and you have engaged employees, then you should actually be registered for pay as you earn. The filing is usually by 9th of every month following the payroll month. And the penalty for not filing in time is usually 10,000. Tax due that is not paid in time is also attracts penalty of 5% on the tax due, and subsequently an interest of 1% should it remain unpaid. Now let's look at withholding taxes, which is also something that most people are not aware of or how it operates. Withholding taxes basically is it's a form of collection of taxes for the government, where anyone who is paying certain incomes, this one you don't have to be registered by KRA or appointed by KRA. As long as you are paying a certain income to a certain person, and you know that income is subject to withholding taxes, you're supposed to actually pay or withhold some taxes from them and remit to KRA. And we will look at the types of income which are subject to this withholding tax. And this one is charged under Section 35. That is the charging law of the same Income Tax Act. So it's what we call a tax deduction at source, because before you pay someone their income, you already deducted and paid to KRA. And then something called a withholding certificate will be remitted to their ledger, which they can use at the end of the year as an advance payment of their taxes due for that year. So some of the incomes which we have are management, professional or training fees. This one is usually withheld at 5%. So if you engage a professional, maybe a lawyer, in that case, so you would have to, before you make a payment to the lawyer after they invoice you, you withhold 5% of that amount and remit it to KRA. And you withhold it in this current month, but you have to remit to KRA by the 20th of the following month after you've withheld. We also have pension or retirement annuity, usually withheld at 10%. And it's important to know that for pension and retirement annuity, whatever they withhold is final, and you will not be required to actually file a return at the end of the year to account for the taxes of pension. And it's important to know that also this pension is something that is paid in a lump sum, because some pension is taxed in the regular way, like the normal salary. That is if it is a regular pension, monthly pension. Then we have an appearance at or performance in any, whether public or private, for the purposes of entertaining, instructing, taking part in any sporting event, or otherwise diverting an audience. And then we have contractual fees, legal fees, and audit fees as some of the examples. So this one basically covers the people we mentioned that they have a vocation, they have a talent somewhere. So for that kind of talent where they appear somewhere, maybe we have someone performing in a sport, maybe running, playing football, or being a lawyer, or being an auditor. So all those kind of fees is some sort of a vocation or a talent or a profession, and they have different rates. For example, for contractual fees is 3%. Legal fees, audit fees is for professionals, so those ones will be charged at withheld at 5%. I already mentioned this, that this the types of income, it depends on the kind of income that is to get the rate that is applicable. So for example, management and professional fees is at 5%, contractual payments at 3%. And if you pay rent to a non-resident landlord, you would withhold their rent payment at 30%. And I mentioned that it could be a final tax or not, which means that, for example, for management or professional fees, if you withhold at 5%, at the end of the year, they still have to file a return, tell us what income they earned, what kind of expenses they incurred to earn that income. Then whatever profit remains is taxed. Then the tax is paid less the withholding tax already paid to KRA by the withholder. Final is, for example, I mentioned earlier, pension, a lump sum pension that's paid to someone who's earning that pension could be withheld at 10%, and that is it. And they won't have to file again a return at the end of the year. Then we have something called, I think this must be the last one under income tax. We have turnover tax, which has been effective since last year, January. And turnover tax is actually tax paid by players in any kind of income, any kind of business whose gross turnover is between 1 million and 50 million in any kind of year. So if January to December you have your turnover being between 1 million and 50 million, you are entitled or you are qualified to pay turnover tax. And it is paid every month, effective from April 2020, by filing a return by 20th of the following month. So for example, a return for February 2021 would be filed by March 2021, and the rate is 1% on the gross sales of that month. And then partnerships, individuals, and body corporates can register for turnover tax if they are within the bracket of 1 million to 50 million sales in a year. So previously, if you may be aware of, then turnover tax used to be for small scale traders. Usually we used to call it a Jokali tax because it was only for individuals only. But now it has been expanded such that partnerships as well or body corporates can register for turnover tax as long as their turnover is between that range. And what is interesting to note is that deduction of expenses is not allowed for turnover tax. It is on gross sales of the month, no deduction of expenses such as you've incurred expenses of maybe paying employees and all that. You do not deduct these expenses under the turnover tax. Unlike when you pay or when you participate in the annual filing of return and payment of taxes. Now, some incomes are exempted from this turnover tax, and some of them are the exempt incomes as per Income Tax Act. There are those incomes which are specifically exempted by the law. So if you check the Income Tax Act under the schedules, then there's a section which has a list of exempt incomes. Then we have incomes which are subject to final withholding tax, such as, for example, qualifying dividends and interest. So such incomes are not subject to withholding tax and turnover tax because they're already taxed under withholding taxes, which are final. Then we have non-resident incomes, that is incomes earned by people who are not domiciled in Kenya. We have rental income, employment income, management and professional consultancy fees. So those kinds of incomes are exempted from turnover tax because there already exists another provision or another way of taxing these incomes as given. So what is the penalty for non-compliance in the case of a turnover tax? Turnover tax late filing penalty is 1,000 shillings per month. This is with effect from 25th April 2020. Then we also have late payment penalty is 5% of the tax due. Interest on unpaid tax is 1% of the principal tax due. Every month it is a compound interest kind of a deal as long as the tax remains unpaid. Then we also have advance tax. Advance tax is a tax paid by, as we mentioned, owners of public service vehicles or commercial vehicles. And in this industry, wedding industry, maybe you could mention maybe large players who may own lorries, pickups, or small cars that are used for commercial purposes. And for these lorries, when you own them, maybe you use them to transport your tents or whatever kind of assets you have for that industry. You pay what we call advance tax, which is usually payable every January of every year or before transfer of ownership if you are selling the lorry. So it's not payable on tractors or trailers used in for agricultural purposes. It's also not payable on public institution vehicles, maybe school buses and all that, or staff vans and buses, or by vehicles owned by exempted bodies. The commercial vehicle rate is 1,500 per ton load of capacity per year, or 2,400 shillings, whichever is higher. So if you have a lorry that is rated at three tons loads of capacity, then the 3 tons times 1,500 would give you 4,500, which is higher than 2,400. So your advance tax for that year will be 4,400. But if you have a lorry, let's say of 1 ton or a pickup of 1 ton, then that one will pay 2,400 because it is higher. Then we have public service rate is 60 shillings per passenger capacity per month. So that is for the small cars that you have, maybe the matatus and maybe small cars like Ubers and all that. 60 shillings per passenger per month. Then this one is accounted for on the 20th of the first month, that is January, for those who have a January to December month. If your year is an irregular one, for example, for the corporates who have their year end starting at a month which is a different one from January, then you will pay that also on the 1st or the 20th of that month. Now let's look at the last tax head, which is actually administered using a completely separate act of Parliament, which is the Value Added Tax Act of 2013. And this one defines, it says that tax or VAT is paid by a registered person, and a registered person is defined by law as any person who is registered under Section 34 of the VAT Act 2013 to be, but does not include an export processing zone, enterprise, or a special economic zone. So anyone that is defined as person who is making taxable supplies is a registered person. And a registered person is one who has accrued a tax liability or expects to accrue a tax liability under the VAT Act or envisaged by VAT Act. And basically it's someone who is supplying or expects to supply taxable goods or services with annual sales of 5 million shillings or more. And then a VAT is charged, collected, and remitted by VAT registered persons only. Under the VAT law, it is an offense to charge VAT if one is not registered for VAT. So it's important to know that for VAT, you have to be registered to be able to charge VAT. Before you send that invoice that has a VAT down there, you must be someone that is registered by KRA as a VAT registered person. Now, it's important also to note that the turnover of 5 million is a requirement for anyone that is surpassing that threshold to register mandatory. But for someone who wishes to register as well for VAT, you can voluntarily register even if your turnover does not go up to 5 million in a particular year. And some of the reasons people register for VAT voluntarily is so that they can benefit from, maybe some places have tenders and they would prefer that you have VAT so that they benefit from inputs and all that. So you can register voluntarily, or if you exceed 5 million, then it's mandatory for you to be registered. So who should be registered for VAT? We have individuals trading in own names. So if you are an individual who wishes to register for VAT, maybe voluntarily, or you have actually traded and or you anticipate that your trades for that year will exceed 5 million, then you can register for VAT. We have sole proprietors who have registered business names as well. Those people can register for VAT as well. Then we have a partnership, which includes a partnership between a husband and a wife who may not be VAT registered. Then they can register as well for VAT. We have limited liability companies, both private and public companies. They register for VAT if their turnover exceeds the 5 million mark, or voluntarily. Any other type of business that does not fit in any of the above categories, for example, churches. We mention this because there are institutions such as churches that sometimes they engage in activities of trade. And those trades sometimes may exceed 5 million, so they can register for VAT as well. So there's a note there that says, basically it's any person transacting in taxable business and meets the threshold of 5 million, or they decide to register voluntarily. A supply will be subject to VAT if it is a supply of importation of goods and services. Tax place in Kenya is a taxable supply. That is, it has to be supply of a good that is subject to the tax at the rates that we know, that is 16%, 8%, or 0 rate. Then it is made by a taxable person, that is a person who has been registered, is made in the course of or in the furtherance of business carried on by that person. It has to be that kind of transaction. You have to make it because you're actually in that trade. For example, if we mention someone who is supplying tents, then that transaction of the supply of tents to a certain person, and you are registered for VAT, then it is qualified as a supply under the VAT law. So there are 3 rates, which is 16%, which we have known for a long time as the general rate. And it is the rate applicable to most of the taxable supplies that we make. And then we have 8%, which is specific for petroleum products in the market. Then we have 0% for what we call zero-rated products. And then we have the due date is 20th of every month. After you've traded, for example, for February, then you file by 20th of March. It operates on a principle of output and input, which we'll cover in the slide later a bit. Then the importer of VATable services pays VAT. We have what we call imported service. That is, if you engage someone from a foreign country, maybe a professional who is not registered in Kenya, and that service that you are importing is VATable, then the person who is actually liable to pay is you, the person who is importing that service. So we have what we call a tax point in VAT as well. A tax point basically determines at what point do you charge tax on a supply of a good or a service. So this is the time at which one recognizes or charges VAT. It is important to know that the tax is due and payable on the earlier of the following conditions. Goods or services are supplied to the purchaser. An invoice is issued in respect of the supply, or a payment is received for all or part of the supply. A certificate is issued by an architect, a surveyor, or any other person acting as consultant or in a supervisory capacity in respect of the service. So any of those conditions, if any of them comes earlier, then that is the tax point. For example, if I issue an invoice to someone, even though they haven't paid me, then at that time of the issue of invoice, that will be the tax point, and you are supposed to account for VAT on that supply during that month. Even though they may pay you maybe months later, but you should have accounted for the invoice on that particular month the invoice was issued. Or if the goods or services are supplied earlier than the invoice, then that time of the supply of goods becomes the period to account for that VAT. So, and then we have supplies are classified into 2 major categories. We have those which are exempt. The ones that are exempt basically do not have VAT. They just are exempt and do not attract any value added tax. Then we have the major category, which is taxable. And those ones are taxed at the 3 rates which you've mentioned: 0%, 8%, and 16%. So most of the time, most of the supplies will fall under 16% category, while only petroleum products will fall under 8%. 0% is for those which have been zero rated. For example, we have examples here, maybe exporting any kind of good or services. When you try to export anything, that one is zero rated, because as a government or as a policy, it is trying to promote more exportation of our goods and services to other countries. So it's exempt, zero rated. Services provided with respect to goods in transit, that is for those goods which are not meant for consumption in Kenya, but they are on transit to maybe another neighboring country. Transfer of business as a going concern, that is if you sell your business as a whole and it's still a business that will keep running or it won't close down, then that one is a zero rated transaction. Ship stores, that is any kind of goods that are bought for the ship. Supplies to export processing zones and special economic zones. Privileged bodies such as KDF. Supply of water by national government, county governments, or any other approved bodies. Those ones are zero rated. We have also maize flour, wheat flour, etc. Medical, vet, dental, and nursing services, and some of the products in that niche market. Then we have agricultural services, animal husbandry, and horticultural services, and unprocessed agricultural produce. Those as well are zero rated. There are many goods and services which fall under this category, and they are also listed in the VAT Act 2013. These are just some of the examples. So this is the formula that is used to determine the amount of VAT to pay, where VAT is determined through an input-output system, and the formula is usually the VAT payable is equals to output tax minus input tax, where output tax is VAT on taxable sales and input tax is VAT on taxable purchases. So if you're someone in business, obviously you will make some purchases to enable you run that business. So basically at the end of the month, you will have all those receipts you received from the purchases that you made. And that is what will form your input tax. Then you also have all the invoices you have issued out because you need to be paid for your services or goods provided, then that is output tax. So the difference between the two is what you pay KRA. At some point, the difference is a negative figure, which is a credit. So that credit you can carry it forward. That is, you made more purchases in that period than what you sold. That's a credit balance. Or at the same time, if it's a positive figure, then that figure is what you pay to KRA. If it's a zero figure, then there's nothing to pay, nor a credit to carry forward. So the collection and enforcement of any sort of taxes is done under the Tax Procedures Act. Tax Procedures Act is a different act which actually collates all kinds of procedures in case of tax laws. Because KRA administers many tax laws. We have income tax, VAT, we have excise, goods management system, and all those have their own kinds of repercussions in case people are not compliant. So the Tax Procedures Act is what actually brings them together so that we have uniformity. So the Tax Procedures Act was enacted in 2015, and it provides for the payment and filing of returns, the due dates that are there, the penalties that are there. And all this filing of returns is always done on our iTax platform, which I'm sure most people right now are registered on the iTax platform. For VAT, one is required to maintain ETR and other records for about 5 years, just in case there's a query from KRA on your tax matters, then you ought to keep your records for at least 5 years. Interest on unpaid amount is 1% per month, accrued on the compound interest kind of basis. You We also have the consequences of not complying, which we've brushed through as we came along. We have late filing penalty of 5% for tax due. And this has been made uniform across all tax heads, whether VAT, pay as you earn, and excise or income tax. That is for the late filing penalty of 5% and the interest of 1% per month on unpaid tax. For late filing, we have different rates depending on the kind of return you have failed to file in time. So for example, for a pay return or a VAT return, 10,000 shillings per month for any kind of return that is late. Income tax for companies, the one that is filed annually, is usually charged at 20,000 when you fail to pay or to file the return in time. Then we also have late filing penalty of 5% of the tax due, or the 20,000, whichever is higher for corporation, for corporates, for body corporates. For individuals, we have a late filing penalty of 5% of the tax due, or 2,000 shillings, whichever is higher for the individuals. So those are just basic the penalties for non-compliance. We've come to the end of the presentation. I'd like to bring to your attention that we are reachable on those contacts given there in case you have any query. We are also present on social media platforms, Facebook, Twitter, and even YouTube channels. So in case of dissatisfaction or recommendation, you can reach us on those contacts at any time. Thank you so much for giving a listen. I hope I haven't taken so much time. We can now proceed to having maybe questions and answers for this next session.
Thank you very much, Arnold. Indeed, that has been very, very well broken down, very well articulated. Arnold, you've taken us through the different taxes payable, looking at the wedding business from, you know, the payee, the VAT, income tax, turnover tax. And I am sure that there's been a lot of learning, and I'm keen for us to have just a moment of questions, of quick dialogue. I see a number of questions coming in. A number of questions have come directly to me, but please, members, participants, feel free to just log them in the chat box. And I will start with actually the question on the chat box from Edwin Motoro. What happens when I'm not registered for VAT and I supply goods to a client who is registered for VAT and they insist on an ETR? How should he go about that? Maybe Arnold, you can take that and perhaps also tell us whether dairy products are zero rated, like the sale of milk, yogurt, and the kind. Just do let us know whether that is zero rated. Perhaps I will ask just one more so that you take them together. You can perhaps make a comment, Arnold, on DST, the Digital Services Tax, and its implications on the wedding industry, and generally maybe the events industry, because we now have a lot more events being streamed online. Please, if you could just break it down, implications on that, and then I will do a few more questions together. Thank you, Arnold.
Thank you, Kezi. So let me dive right straight to the chat box and answer the question from Edwin Mutoro. He says that what happens when I'm not registered for VAT and I supply goods to a client who is registered for VAT and they insist on an ETR receipt? I will just take you back to our presentation on VAT. VAT is only charged by people who are registered for VAT. It would be illegal for you, let's say Edwin, to charge VAT on someone if you're not registered for VAT. And for the other party to insist on an ETR receipt when you're not registered, I don't know why they would insist on that, because if you send to them an invoice that does not have VAT, they are free to process it as an invoice that does not have VAT. But if they insist on an ETR receipt, that's just maybe their own business policy, but it's not as per the law. Because most people, when they are registered for VAT, as I mentioned, there is the VAT input-output operation system, whereby the more purchases I make, technically the lesser maybe the taxes I would pay. So they would insist on maybe an ETR receipt because they need to use it for their own tax planning on VAT. But really, you are on the right if you issued an invoice without VAT and you are not registered for VAT. So it is still okay to issue an invoice without VAT if you're not registered for VAT. And if they insist on that, maybe because of their own business policies, you may lose the business, but as per the law, there is nothing you did that is wrong. So maybe the best solution or how to go about it is your own conversation with the clients or your clients. Because if you issue an ETR, a receipt without an invoice without VAT, there is nowhere that can force them to ask you to have an ETR receipt on that. I hope that one is clear. That's why we mentioned earlier that in the industry currently, we have people voluntarily registering for VAT because of such clients who insist on you having an ETR receipt. So for you to not lose certain businesses, people just choose, let me voluntarily register for VAT. But technically, no law will force you to issue an ETR receipt if you're not registered for VAT. Dairy products zero rated, like sale of milk, sale of yogurt, and the likes. Yes, these ones are, it will depend on what you're selling. For example, if you sell raw milk and all that, which has not been processed, then they will not attract VAT. But anything that is processed now will start attracting taxes. But still, as per the Act, anything that is processed, if you go to your supermarket and all that, these things are still zero rated because they are considered basic food stuff for households. That's why they are given the zero rate. But basically, as a rule of thumb, any unprocessed dairy product, fish, for example, that is sold in at the market, maybe at Kisumu markets where they are just fished and sold, that ones they are zero rated because they are unprocessed. The moment anything goes through some sort of processing, that one is what we call value addition. Therefore, they would attract taxes at the general rate. And then you mentioned, Casey also asked a question on the digital service tax. This is also a new tax that has been introduced from this year. And it's basically, as the name says, tax on provision of a platform in the digital space for trading. Let me give an example of something like YouTube. YouTube is a registered digital service tax agent for KRA because their incomes are derived from people using that platform to reach many people. So for example, in the wedding industry as well, we may not have people directly paying digital service tax unless you actually provide the platform for others to advertise their products and do all that. And then for that provision of the platform, you get some money or you get to invoice them for using that platform. That is what digital service tax is about. It is someone who provides a digital platform has been appointed by KRA as an agent, such that for any kind of invoice they issue to now the users of that platform, then they get to deduct about 1.5% from the invoice value. So that's the difference. It will not be everyone that will pay as an agent the digital service tax to KRA, but you might get some deduction of 1.5% from someone. Now, maybe the people you've engaged Facebook or you've engaged YouTube to do some marketing for maybe your event company. So they will deduct 1.5% of that invoice and remit to KRA themselves. I hope that one is clear. Then do we have any other questions from the participants? Yes.
Yes, I have a question for you, Arnold, on the question of turnover tax.
Turnover tax, yes.
A number of businesses in the industry receive money on behalf of the client to expend on behalf of the client. A classic example would be a planner, an event planner or a wedding planner who receives sums of money that are supposed to be expended on behalf of that client. For example, pay service providers. And I'm wondering how you treat that for purposes of turnover. because it's not necessarily revenue generated by the business. The business is essentially a conveyor belt because of the nature of services the business is offering. It's a consulting service or it's a planning service. So you're simply a conveyor belt. How do you treat that for purposes of turnover tax?
Okay, thank you, Kezi. Edwin says, yeah, thank you, Arnold. Say I now go ahead and register for VAT just so that I don't lose the client. Am I allowed to issue invoices without VAT? Or moving on now, all my invoices must have VAT? That's correct, Edwin. Once you are registered for VAT, all your invoices should have VAT if it is a supply that is taxable. You will not go back to now choosing to issue an invoice which does not have VAT. Once you are a registered person, you charge VAT thereon going forward. And on the matter of turnover tax asked by Kezi, turnover tax is based on revenue that you actually recognize in your business as revenue to your business. That is, an invoice has been issued that now for my event planning services, I will charge you this much. That is what we call turnover for your sort of business. But if you hold some monies as in trust for the client, basically that's not your money. That is money that will be used for the client's event. Maybe if it's a wedding or any other sort of event, that money you're just holding as in trust for them. It's the same way lawyers do when they have their accounts. They have client accounts where someone can just deposit a certain sum of money to be used in future, maybe if they have cases and all that. So the same way that operates is the same way if you are an event planner and you have such an account for your clients, the only thing we'll recognize as your turnover for the purposes of turnover tax will be the amount that you actually charge that client for providing the services of event planning, let's say. So your turnover, you will determine based on your own invoices for providing that kind of service.
Okay, thank you, Arnold. And speaking of lawyers, you mentioned on the withholding tax, and perhaps you might have, the last I remember was a decision in 2019, I believe, by Justice Professor Ojienda, in which there was he upheld, in the Court of Appeal upheld a stay of execution against, on the matter by the LSK on withholding tax. I don't know whether you might have any new information around that. That is withholding tax when it comes to lawyers. There is a follow-up question on the issue of turnover tax, on whether does it now mean that we need to establish escrow accounts, or because a class 6 scenario is where a wedding planner will raise an invoice for the entire value of the project or the entire cost of the project, including sums that will be paid out to other providers. Maybe you will make a comment on that. Now, an additional question around payee is this, the industry is very heavy on informal, unstructured labor agreements or temporary labor or casuals, if you may. And maybe just to make a comment around payee obligations, where a business, an informal business, or even if it's formally registered, has a contingent of employees who remain as informal workers or casuals for a period of time. And lastly, I hope, Arnold, maybe the last one in this round is there a period within which or outside of which KRA cannot raise claims? For example, I think this question is being asked out of a scenario where KRA will constantly raise claims or purport to do audits for years past. So they will raise a claim from 2016, they will then now say that's settled, a year later raise another claim from 2015. Is there a period within which KRA cannot raise, or outside of which KRA cannot purport to do an audit? So yes, take those for now, and then we will probably do one or two more questions.
Okay. So there is a follow-up question by Catherine on meaning, do planners need extra accounts or clients for turnover tax? I think what Catherine is asking is that is it now more of a necessity for planners to have escrow accounts to deposit maybe funds for trust? But for this one, I don't think it's really a necessity. It depends on how you run your business now. Because, for example, as Casey mentioned earlier, there's sometimes you issue an invoice for the total services. For example, you say for your event planning, what I will require for you, maybe a wedding cost maybe 800 shillings, let's say, for an example. You will tell them, just give me the 800,000 shillings. We will use it to do this, so and so. We will pay the DJ, we will pay provisions of or providers of deco and all that. So that amount, wholesome amount, 800, will not be considered turnover because part of it is expended on other services. So when you issue an invoice, let's say as a wholesome, that will be considered for VAT maybe as the turnover. But at the end of the year, when you now do your income tax return, the 800 will be turnover, but you have also incurred expenses in paying the DJ, in paying the providers of those other services. So at the end of the year, it will only be the profit that you get from expending that 800 that you've earned, and the rest are expenses which are deductible because you had to incur these expenses to earn the profit. But for VAT, that then will be taxable because you have issued an invoice on VAT. So if the same providers that you pay, maybe the company that provides the music system or the grounds, if they issue an invoice again for which has VAT, then you're at liberty to use it as your input taxes for purchases. Therefore, you will have the normal VAT in output, input, determine what is payable there, and pay whatever is payable. And then the next question, let me just answer what is on the chat box first. Edwin Motoro is also asking that are construction materials like sand and ballast vertible. So this is someone who is in the construction industry. Now I'll mention something right off the bat that this is an industry where for a long time in Kenya, for example, when you go to a site that is a quarry that has ballast and sand, most of the time you'll find that it's an informal setting where you don't even have paperwork. You just go and say, I need 2 tons or 20 tons of construction materials like sand. You get it and then you go and deposit to whichever site that is there. So most of the time people do not tax these, and they say that because it is an informal sector or there's no paperwork that exists, then it should not be VATable. But I'll draw to your attention to the VAT Act, where anything that is not on the schedule of 0 rated or exempt, then that one is taxable at the general rate of 16%. So you will find that at some places you go where they have a formal setting of a hardware that can supply you ballast and sand, that person will charge you VAT on ballast and sand. And they'll be doing the right thing because the supply of ballast and sand is not exempted or 0 rated anywhere on the Act. So that's something that maybe compliance needs to improve on in the industry. And then now we can go to the questions that Casey asked about for pay as you earn. You say that most industry players here, they engage people informally. You would need someone to come and fix your tents, maybe arrange the flowers and all that. It's some sort of an informal setting. Maybe the pay as well may not be that much. But the guiding principle when it comes to pay is does the person or does the income meet the threshold of taxation under the pay as you earn? For example, we mentioned that someone earning above 13,000 in a particular month is eligible to be deducted fee and paid, or at least they should be on the payroll of the pay return that we KRA sees. So in case it is a situation where these people, whatever amounts they earn is less than the 13,000 in a month, then that would be considered as wages. And wages will not be subject to tax if they don't exceed the threshold provided by the law. At the moment, even in this current year, in the Finance Act of 2020, the minimum taxable is 24 by the virtue of the personal relief. So if you are earning 24,000 in a month and below, it means you will not even pay any taxes. And but if you earn more than that in the month, then you will start earning more. You'll start having taxation on the amounts above 24,000. Then there is the question of KRA raising claims after what kind of period. So as I mentioned earlier, when we were doing the VAT presentation, we had that section where a taxable person has to keep their records for about 5 years. That one also goes in line with the provisions that KRA cannot do an assessment on someone beyond 5 years after that transaction has been concluded. But there is an exception that if you're being investigated for tax fraud or serious tax crimes, then all books are open. Then any kind of amount can be, or any kind of year can be opened up. That is, if you have been suspected to be have done anything that is against the tax laws, and maybe the investigation department has sent you a notice on the same. But technically, on the normal course of business, we limit our assessments to 5 years of raising claims. Then there was the question on lawyers and the withholding taxes. Lawyers are professionals as by the law, defined by income tax, which means their incomes are subject to withholding taxes. I just remember that a few years ago, there was a tussle between KRA and the Law Society of Kenya on whether, for VAT purposes, lawyers should even have ETR receipts, and that has been on a standstill. As you mentioned, there is that order that was issued. At the moment, maybe they may not issue the ETR receipts. There is even a time the ETR receipts were stopped, not being compulsory, but still you have to issue a tax invoice which has respective VAT and all that. So unless there's any, maybe you can move on to the next questions if we have any from the panel, from the attendees.
Okay, just one more.
Yes,
One
yes,
more,
please.
2 more. And perhaps you can stop sharing screen now, Arnold.
Yeah.
Thank you so much, just so that we get to see your face. So this last one has got to do with a scenario where an industry player has filed their returns, or rather they have done the voluntary filing, but then what they receive from KRA is a notice of under declaration of sales for the month in which they have done their voluntary declaration. And KRA proceeds to indicate that they have detected sales out of withholding VAT certificates that the industry player has not received. So perhaps your advice on how this person should handle the situation. Just maybe to go over that again, is a scenario where one has done a voluntary declaration, but KRA issues a notice of under declaration. Maybe just to go over that, how that should be mentioned. And then I think, and someone is asking, what is the voluntary tax disclosure program? You could take that one as well. And also, I think to address a scenario where a claim has been made by KRA and an arrangement for payment has been entered between the taxpayer and the tax collector, but in the process of that, there is animosity, or I don't know how you would put it, a sense of tussle from the KRA official. We began by saying that the taxpayer has obligations, but they also have rights. So what to do where a taxpayer is faced with a hostile tax official? And ladies and gentlemen, we will be coming to the end of the Q&A session. I bet you might all know we have probably exceeded the time window that we had for this. But Arno, thank you for being gracious. Please take that last round of questions. Thank you.
Thank you, Kezi. So we have 3 questions here. Let me first answer the one on the chat box, which says, what is voluntary tax disclosure program? This is what we usually shorten to VTDP in our circles, but the voluntary tax disclosure program is a program that runs from 2021 all the way to 2023, that is 3 years. And it's basically an amnesty sort of thing that is extended to taxpayers to disclose any kind of maybe sales that were not declared before. And you do this voluntarily, which means KRA will not even assess how much you've declared, or you will not be audited on what you have declared. You just declared voluntarily. And as a result, when you do declare these undeclared sales and pay taxes on them, whatever interest or penalty that was supposed to be levied because of filing late or declaring late will be waived 100% if you do declare them within the current year of 2021. The next year of 2022, if you declare anything, you get a waiver of penalties and interest of 50%. And finally, in the last year of 2023, if you make any declaration, you get a waiver of penalties and interest of 25%. So the earlier you do it is basically the better for you for the penalties and interest. And this is a call to everyone. It's all taxpayers who may think that they have underdeclared at some point. Even if you don't know or you don't have current knowledge of maybe an underdeclaration in any year, you are called upon to just assess yourself, maybe engage a tax consultant, auditor, check your records. If there is any sort of underdeclaration, then you can take advantage of this VTDP program and make declarations and pay the taxes due within the 3 years that has been provided. Now that means that if you do not maybe take advantage of this program, KRA can, if they have any information on any undeclared sales, they can still make assessment on the same, as long as it's within the stipulated timelines. So if you are someone who is thinking on participating in the program, please do participate. Then there's also the question of hostility from maybe the tax official that has been handling your case. As you've mentioned aptly, taxpayers have the rights as well and obligations. So if you haven't met your obligations and you have been summoned maybe to KRA to talk about or discuss your tax matters, it's within your right to actually appeal whenever you feel maybe an assessment done by KRA is not correct and you have supporting documents. You can always, there are ways of resolving disputes, which we call alternative dispute resolution. One of them is, the first thing is you lodge an objection to any kind of assessment that has been done by KRA, and that one has a due procedure. Once you do it within the 60 days of assessment, then there will be a process where you provide your documents, you give your reasons, and if it meets the threshold or the commissioner is satisfied, then that objection will be upheld. Or if at the same time you do not merit, then it will be vacated and you will still have to pay the taxes due on that. But let me mention that no officer of KRA should be hostile or when handling taxpayers. It should always be within the law. So no one can force you to do certain things. And we've mentioned that there are mechanisms of handling such, which means you can either report whenever there's a hostility, there are channels of reporting such. That is, if someone is behaving in a way that is out of the boundaries or the meaning of your obligations and your rights, then you have channels to direct that complaint. And then there is the question of when someone makes an assessment or a self-assessment. We have the first return that someone files is called the self-assessment. That is, the taxpayer has assessed themselves from their transaction and has made a self-assessment declaration in our iTax platform. Then what happens when KRA issues another additional assessment to say that you have underdeclared on this invoice? A number of scenarios can arise. Like, for example, one of them is that taxpayers may declare based on a figure that is not the same as that one which was used to withhold the taxes. For example, we mentioned for VAT, for example, withholding rate is at 2% at the moment. So if a certain person you have engaged for business has withheld your taxes at 2%, then it means we can calculate if 2% is this withholding amount, how much sales do we expect to be declared by so and so. So if we come and see that you have declared less than what the withholding certificate says, then that's when an additional assessment is done by KRA on the same amount. So it's important to know that the variances between the invoices that are there that you've declared and the withholding that we have, it gives us a basis to query and ask you, why are you declaring less sales than what was used to actually declare your withholding taxes? And if the invoice that you issued is actually as per the withholding taxes, then I'm afraid then there will still be taxes to pay on the sales that are undeclared. But in all those, once an assessment is issued, as I've mentioned, there are channels to deal with this. Usually we even make calls before we do an assessment on the taxes that are less. So sometimes when you're contacted and asked to provide maybe a clarification, it's important for taxpayers to just cooperate and maybe clear out the situation before it gets to a point where it has to be assessed on the system, electronic system, iTax. So that's all for the questions that we had for today. Thank you so much for participating in this, and I hope you've been enlightened on this. Someone mentioned earlier that they need the slides from KRA. I don't know how we can conduct this. Maybe JD can guide us on how they can be distributed later on. But thank you so much. You've been helpful, and the questions that were asked were also those that will help many other people, not just the people who asked. Thank you so much.
Thank you very much. Allow me to just give a big appreciation on behalf of Samantha Sprider, and also on behalf of the Win Africa Summit, the Win Summit organized by Samantha Sprider. Thank you very much, Arnold. And thank you also to Jedi Ochodo. You have really, I believe you have in a big way shed light on some critical issues for the industry. And ladies and gentlemen, allow me to hand it back over to Catherine for closing remarks. Thank you very much.
Wow, that was quite enlightening on a couple of issues. Let me also say thank you to the participants. We had many people tuning in on YouTube. Here we had almost like 50 people. Here at one point we had 35, so that's really good. And I think this will go a really, really long way. If you compare when we launched in 2004, the industry was very informal. And right now we have businesses that are formalizing. The experience industry in general is growing in leaps and bounds. So it's important that we have more people coming into the tax bracket, not just for the revenue, as we have said, for the national pride, it's really important, but also so that we are able to even sell our businesses if we want to sell, and be able to be recognized. For example, recently, last year when the pandemic happened and there was all these reliefs, so if we are contributing to the tax payment, then the government would actually then also think about us. Not that they are not thinking, but our issues would be heard. So this is really, it's been quite a couple of issues that have been brought to light, like the turnover tax, collecting money on behalf of clients. So, and I also want to mention that you've seen Arnold and JD, they are really, really friendly. And my dealings with the KRA is such that initially I would hear KRA, I just want to collapse. So many people, they just want to fall down just by the mention of the name. But they're really friendly people. And, you go, you say whatever it is, you ask for guidance. If you want them to come back, they will come back. And I think it is, the more you know, the more safer you are. And so let's pay our taxes so that we can build ourselves. So the Win Africa Summits will continue. I want to thank Eunice Mwei, who was in touch with who organized this, and she will keep organizing. I wonder where your face is, Eunice, so that people can see you. And she's an alumni from the Wedding Marketplace Business Academy, where we train the industry, we train people, anybody who wants to get in the industry, especially the newbies, the people who are new in the industry and they don't know what to do. These are the people we really deal with, but we also provide capacity building for even in, learning institutions. We coach. Eunice, perhaps you want to say just a quick hi, and then I continue to close. Eunice?
Yes. Thank you so much, Catherine, for this opportunity. I want to thank Arnold and JD for agreeing to come on board and for sharing what you've shared. It has been a very insightful session. And I also want to thank the participants, those who have joined us. And the video of this video will be available in our social media for those who were not able to join us. And for the next summits, the WIN summits, I look forward to the next summits, and I invite all the participants to join us. So thank you.
Thank you so much. Let's continue engaging on our social media platforms. As Eunice has said, we will pass over the slides so that we can continue to learn. Like I said, we want to encourage each other. We want to learn. We want to create networks, not just in the region, in this country, only in the region, and all over the world. So we shall be seeing speakers from everywhere. And Kezi, thank you so much. You're such, like I mentioned earlier, I always feel calm working with you. You're always such a pillar of strength and calm for us in the industry. Kezi is a lawyer by profession. And so for those of you in the industry who may need some legal advice, you know, we use contracts to get services, to secure services. And also any legal thing, Kezi is always available to help. And I'm sure they know how to get you. Kezi, thank you so much. And to Kare, thank you. I think I'm going to end the meeting.